Up next, we have a very special event. We have a fireside chat with Nick Jacobson and CapitaLand Managing Director, Private Credit, Arjun Pandit.
I think we should probably start, as it's a question on most people's minds, is trying to get a better understanding of the rationale behind CapitaLand's purchase of Wingate.
It's a very simple answer, Nick. For CapitaLand, private credit is actually a core strategy. In fact, it's a highest growth strategy within the company. We manage roughly $120 billion, but private credit is only $3 billion out of it. And when we looked at our business in Asia Pacific, Australia, of course, has attracted a lot of attention, was always on the radar. The issue we had was to find a partner that culturally aligns with CapitaLand. We were very fortunate to work with the company, with Wingate, on the two transactions that Karan mentioned. Personally, I had the opportunity to work with a lot of the team members, and I think it was more about that cultural fit. Ability was obviously not a question. So for us, we are very, very fortunate, I would say, to have had the opportunity to get Wingate into our family. And you will see good things happening from here on.
No pressure. If I could ask...
I thought the pressure was on you.
You obviously have a global perspective. We're based here in Australia, and a lot's been said about the marketplace here. But within the context of the Asia-Pac market, how is that private credit market in real estate evolving in the context of the broader private credit space?
So I think most investors and professionals like us get caught up in the moment. But the reality is private credit is now mainstream investment as part of the portfolio for large institutional investors, including pensions, insurance, and sovereigns. It's been demonstrated in the US. Europe was post-2012, had a great growth. Asia has always been a little slow because we are bank dominated. Let's face it, all of us know this. But in the last 6 or 7 years, we have seen right across the region similar patterns, regulatory changes on the banks to use their capital efficiently. Professionals like us who are essentially bankers moving into private credit. And then more importantly, we have the trust of long-term capital behind us. And that capital is very competitive vis-a-vis the banks. And so this theme is through developed markets in Asia. Australia is leading it. We see this in South Korea, Singapore, and now Japan.
You mentioned the growth of private credit and the relative underdeveloped nature within Asia-Pac, relative to the US and Europe. How's CapitaLand positioned in that context, given the history of being a global fund manager, but based in Asia?
I like the word global. The reality is CapitaLand has always been an Asian manager. I mean, we've had boots on ground in all Asian countries for a long time, in different shapes and form. And so for us, the natural evolution was we would never do lending or a credit business where we have not invested ourselves from an equity perspective. The other element was localization. And one of the reasons why we were fortunate to buy Wingate was really about localization. It's a local business. From an investor perspective, certainly, and I can see everyone in this room, but also from a borrower perspective, and from who we lend to. So for us, when we have an infrastructure in Asia Pacific, it was a situation of adding product, and therefore private credit overlays that infrastructure and the backbone that we have. We are a full-fledged manager. We develop assets, we lease assets, we operate assets across residential, logistics, data centers, hotels. And so private credit now has a great opportunity to leverage that backbone and flourish.
Arjun, you mentioned earlier, and it's a point that we face here, is that it's a very bank-dominated market. And what we've noticed is the banks are becoming more heavily regulated by the prudential regulator, APRA, but also the impact of the Basel program of regulations Do you think it's consistent with what you've seen in other markets you operate in, that Australia will benefit from a private credit perspective because of that focus on the bank sector?
Private credit should never be thought about as a tug of war with the banks. The banks are the glue of credit in our economy, in our systems. I've been a banker for 21 years, but the reality is banks have become a very strange animal. You see, banks are supposed to take our deposits as consumers and lend, and they stop lending at the time when you really need them. I mean, this is the reality. Your regulations are there from a perspective of risk management and efficient use of capital. So banks are being treated as utilities as far as regulators are concerned. And with that pressure, the banking system has become pretty in inertia to do anything useful. So we find the same themes in places like Singapore, Japan, a lot of deposits. I mean, they are the cheapest cost of capital. But when it comes down to developing projects that have importance to the society, large projects, projects with a little bit of imagination, they only have a box you have to fit into that. And that's where I think private credit wins, not on the fact of being the cheapest cost of capital, but the most relevant for our borrowers.
We spoke, and I alluded to it in my opening remarks, about the increased scrutiny from the regulators that the private credit market is undergoing in Australia. What's your perspective on that?
So there's a few things. I mean, what's the definition of private credit? And let's talk about in the context of Wingate. We are focused on property, as you know, and as everyone knows. We have an institutional style business. Our borrowers are very credible. A lot of the noise that has happened in private credit has been on the lower segment of this market, where it touches consumer products. Deposits, sometimes people are doing consumer loans, credit cards, auto loans. And there is a lot of hot money in certain segments of the sector. We talk to regulators on an ongoing basis at CapitaLand. In fact, we try to shape the regulatory dialogue. It's a healthy dialogue with regulators. We want this industry to be growing in the long term as coexisting with banks. Therefore, it becomes important to shape the discussion with regulators and understand their concerns. And their concerns are primarily twofold. The banking system, that nothing happens like we saw in the global financial crisis. And the investors who are there with us understand the products that they're investing in. For CapitaLand, when we were looking at the acquisition of Wingate, that was a central question. And we were very confident after the diligence that was conducted, and as Karin mentioned, maybe too long, that this is actually exceeding standards. So it's not meeting standards, we are exceeding standards. And so maybe as a final point, I do feel there'll be winners and losers in private credit, and I do believe the place where I'm sitting is going to be one of the winners.
I absolutely agree with you. When you look at the space, and obviously the focus for us over the 20 years in this market has been around property. Mm-hmm. When you look at the risk-adjusted returns that we're all targeting, which sectors do you think are offering the best risk-adjusted returns?
So it has to be informed decision, and it's a dynamic discussion. It's research-driven. This is the reality. Markets change. There is no one formula. For us, I think I'm echoing the Wingate senior management. It's about the living sector, and living includes build to sell, which has been the bread and butter, but student housing, BTR, co-living. And then obviously, as we are broadening the platform, there is the origination machinery of Wingate, led by Mark, where we see opportunities and large loans in sectors that were traditionally not private credit, so such as logistics and even mixed use. So I see probably thematic living and based on the research, and large loans on some of these other thematic sectors like logistics and mixed use.
Glad we've got it right so far. What's your outlook if you're looking at our market on interest rates and what that implies for the refinancing risk in credit?
So there are two elements to that question, Nick. What does low rates do? If you go back to zero again, hopefully we don't, all of us should be in healthy economies. What does it do to the attractiveness? I think from, again, what I see at Wingate, but that echoes the larger theme at CapitaLand Credit, we look at, risk-adjusted returns. So we are trying to have a benchmark plus 500 basis points, for example. That discipline will always be maintained. I think to have a healthy market, we need real estate activity. I mean, yes, last few years has been great for private credit. The rates are high, but the volumes are low. So to me, I think it's good the rates are coming off. The builders, the borrowers will have better feasibilities, and we can then get into the volumes game, because that's what is important for us, and a healthy economy requires us providing the credit at certain part of the cycle, and certain part the banks will come and refinance. So I feel pretty good where we are with the rates coming down. I don't think it's going to zero, but I do see the pipeline. You mentioned 6 billion. We see it's really executable.
And finally, we're the latest and the first acquisition that CapitaLand have made in the private credit space. We represent about $3 billion of funds under management in $120-odd billion within CapitaLand. What are CapitaLand's global ambitions in private credit, perhaps just to finish?
So no pressure, Nick. But the reality is, publicly stated, we're a listed company. Our total funds under management in the next 3 years is supposed to go from 120 billion to 200 billion. And what I've been told from the board is the private credit has to make up at least 10 to 15% of that. So hopefully taking the 10%, we're looking at a $20 billion business, which means 3 billion to 20 billion. Now, I do want to emphasize one thing. Growth for the sake of growth is not what we look for. It has to be responsible growth. So I think where we see opportunities, CapitaLand will use its own capital and balance sheet to secure transactions. And then in a responsible manner, when our capital partners come in, we are ready to absorb that risk. If we find the risk is too high, some of our peers, not in Australia, but generally in APAC, are just in the business of deploying. We would not do that. But today, I think, just looking at the pipeline, I would rather do a lot more than less.
Arjun, thank you for your time. Appreciate you coming down.
Thank you.
Thank you.